Welcome, ladies and gentlemen, to our second podcast. And I'm really excited. If you did come back, that means you must have watched the first one. My name is Douglas Muir, and I'm the CEO and founder of the Family Business Fund. Because I wanted to start doing this because traditional investing is dead. That's the name of the podcast. That's what I believe, and I'm going to prove that to you. Today, we're going to talk a little bit about alternative investing, and is it for you? I was visiting with a friend at a pool, and she just moved down from New York to Boca, and that's where we are located. And as I was explaining what we do, she's thinking, oh, this is too risky, little too risky, too risky. And that's exactly what I thought. And if you're watching this podcast, that's probably what you think, but it's not. That is the biggest fallacy. Alternative investing is safe, and it pays very well. And I'm going to show you and just talk to you a little bit about what I learned before I started my fund. So let's start off with this. My attorney said, to make sure I tell you, I am not a financial advisor. I'm actually a retired airline captain. So what does an airline captain know about finance? Well, I know a lot. I was on Wall Street for a couple of years. I was actually on the New York Stock Exchange. And when I was watching the board and I was just watching all this come down from one tweet and then all of a sudden going back up from another tweet, I thought to myself, there's got to be a better way. And there is. It's called alternative investing. And that's what we're going to talk about today. A few things that I want to talk to you about is, what's a hedge fund? You've heard the word hedge fund. You've heard the words private equity. I actually owned a private equity fund, and I've owned one for 15 years, and now I own a hedge fund. So what's the difference between those? And traditional indexing, what does that mean, traditional indexing? You know, we got all these high class words. It's very, very simple. And we're going to discuss that just to get you caught up on the verbiage that we talk about when we're talking about financing and that you really need to know. And what is merchant cash advance, or MCA as we call it? We're going to get into detail because that's what my fund, the Family Business Fund, does. And that is called the underlying asset. And then what is the Family Business Fund? I'm going to tell you all about it. All you have to do is just stick around for the first 10 minutes of this, and we're going to get right into it. So I threw out a lot of terms: hedge fund, private equity, indexing. What does that all mean? Well, let's start off with a hedge fund. A hedge fund is a fund that people put money in. What kind of money are we talking about, and what kind of people? Well, they're called accredited investors. And accredited investors, as we'll talk about as we go along here, are just people who make over $200,000 a year for the past 2 years. So if you're an accredited investor, you can go into a hedge fund. And a hedge fund is actually alternative investing, as I was just talking about. And people who make over $200,000 a year can get into this. I had no idea that existed, and I was making way north of $200,000 a year. My financial advisor never advised me of that, which kind of upset me, but I learned why, and I'll explain that later. So what does a hedge fund do? A hedge fund hedges their bets. So that means they will bet on A horse, but then they'll bet some money on the B horse, just to make sure if the A horse doesn't win, the B horse may come in second. Do you see what I mean? It's just the way it works. They hedge their bets. This is the difference between a hedge fund and private equity. A hedge fund is in and out, in and out. In and out. They're in and out of trading very, very, very fast. But there's different types of hedge funds. There's a hedge fund like I have, which is all about debt. So what I do is I buy and sell debt. Very easy. I buy the debt low, I sell the debt high, the profit margin, some of it goes to the investor, and the rest comes to me. That is what a hedge fund is when you put it into the short terms. The next one I want to talk about is private equity. When I sold my company to a large, and I mean a large investment firm in New York City in about 2004, I was sitting on a lot of money. And instead of investing in that, in the market, as we call it, which is the New York Stock Exchange is a market, and the London Stock Exchange is a market, and the NASDAQ is a market. I took my money and I said, I'm going to start my own private equity. So I have a private equity company, and it's my money. So I'm using my money. Other private equity companies where people come in, accredited investors as we talked about, and they put money in and they get a certain amount. My private equity is more long-term, normally about 5 years. So it's a longer-term investment, and it's actually a lower market risk than a hedge fund because you get to ride out certain highs and lows of the market. So private equity normally comes in and stays in. They'll buy companies, they'll invest in companies, and that's what private equity is. But the family business fund, we'd be considered a fund or a hedge fund, if you will. But we're not in and out really fast. We kind of buy debt, hold on to it for about 4 to 6 months, and then resell it, okay? So the hedge fund versus private equity, which would I recommend? Well, I own a fund, so I would recommend me. But there's some great private equity groups out there where you're going to be able to come in, put your money in, they're going to hold on to it for about 3 years. It's called a lockdown. My fund, the family business fund, we only lock you down for 18 months. And normal is about 3 to 5 years. And so that's the difference between a hedge fund and private equity. Hedge fund, in and out quick. Private equity, holding on for 3 to 5 years. And you're making anywhere between 15 and 30% sometimes. Sometimes you may lose it all. Not much and not many. Let's talk about stocks and bonds. What actually is a stock and bond, right? A stock is the traditional investing. So there I am. I'm on the floor of the New York Stock Exchange. I'm looking up at, they call it the big board. My phone rings. All of a sudden I look at it and it's a tweet and it comes from the president and it says something about the market. And I look up and I'm just watching the market go through the roof, and then all of a sudden I'm watching it come down. That is called volatility. The volatility on the floor of the New York Stock Exchange will literally blow your mind. And I'm sitting there and I'm watching this traditional type of investing, and I'm hearing my financial advisor in my ear going, no, the equities and stock tradings is safe. It's really safe. I was like, what am I missing here? I gotta be missing something. So that's when I started really looking at what else is out there. You have the stocks and bonds, which bonds are safe, stocks not so much. Okay, because people are trading like this, and they're trading on their heart, right? 60% of the trades now on the New York Stock Exchange are from people like you and me who have these little accounts, and we're like, yeah, trade, right? It has nothing to do with the basics. It has to do with the news of the day, and that's what's happening. A perfect example is GameStop, what happened with GameStop. And GameStop was ruled by this thing called a meme, M-E-M-E, and it's just a guy coming in saying, buy, 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 and everybody who follows him, like 2 million followers, they start buying, and all heck just breaks loose. So the stock market is not as safe as everyone would like you to think, and so that's why when I got out, I wanted to start my fund. And I normally did it for myself. I was just trading my money. I was just buying and selling debt on my money. But actually, my friends heard about what I was doing, and they started putting in money. And before you know it, I had a fund. And my friends that came in had to be accredited investors. And remember, we discussed that. An accredited investor is someone who makes $200,000 a year or more for the past 2 years, $300,000 with a wife or a husband together, or liquid $1 million, not including your house. So if you're watching this and this is you, you have access to so many other different types of trading platforms, not just stocks and bonds, but alternative investing. It would really blow your mind because your financial advisor is not going to tell you about it. Give me a call. I'll tell you about that. And that's what if you're an accredited investor. So let me tell you about Merchant Cash Advance, because we talked about that in the beginning. The Family Business Fund is a direct lender to Merchant Cash Advance brokers. Okay? So you have the broker here, and the broker puts out advertising, and a business who needs cash comes to the broker. So you're asking yourself, Why don't they just go to a bank? Because they may have a judgment or a tax lien or something on their credit where the banks will not. Maybe they're not very truthful on the IRS forms, as we all small businesses may know a little bit, right? So if that happens, they need advance on the cash. And so what we do is a company will come to the broker and say, Mr. Broker, I am going to make $75,000 in the next 5 months. I need cash on that $75,000. The broker will then come to me, the Family Business Fund, and say, I have this client who's going to have $75,000, and I say, okay, I'll give them $50,000 cash right now, today, for that 75, and I'll collect the 75. It's called an advance. And without that, a lot of these companies will literally go out of business. And we don't want to do that here in the United States. Right? We want to give people a second chance. And as we are funding these companies that can't get banking yet, they will sooner or later get good credit and get the bank, which will lower their rates. And that's what we try to do at the Family Business Fund when it comes to merchant cash advance. So by investing in the Family Business Fund, you're literally helping small business America in the economy. I know that sounds cliche-ish, but it is so true. I could tell you story after story of people. I'll tell you a quick story now. I was just in Las Vegas, and a limo driver picked us up, and it was a company that we funded, and he was 2 nanoseconds from going out of business. And we funded him with just a short $50,000 cash advance. And he picked me up with his new car. We helped him with his business, and now he's a successful limo service in Las Vegas. If that didn't warm my heart, nothing else will. And I'm telling you from the bottom of my heart that alternative investing is a safe way. Call me up, let me talk to you about how we could help you. Even if it's not putting money into my fund, there's so many others I would like to introduce you to. I invest in REITs, real estate investment trusts. And I have one in Austin, Texas. I have an investment in Sarasota. Austin, Texas pays me 12.5%. Sarasota pays me 9.5%. I mean, just think about it. These are fixed rates. Every month you get this money in. It's like clockwork. Alternative investing. It's the way to go. So thank you for watching the second podcast, and I hope you've learned a lot. Please call me or email me at any time. Podcast 3, Small Businesses Unmasked. You're going to love it.